sequence in the cycle is that you have a growth phase, you have a peak phase, then the third is the recession phase, and the fourth is recovery. It doesn't really matter what sequence they go in. Those are the four elements of the cycle. They all follow each other. So, sorry, the sequence does matter. The starting point doesn't matter. So last time around, we actually had a growth period that, in my perspective, lasted about 16 years. That's twice as long as a normal cycle. And I attribute that to globalization and the advent of free trade agreements and double taxation treaties and investment protection agreements that happened over that period of time, and preceding it as well. So essentially what globalization has done is to stretch out the cycle. Now, the difficulty was, unlike any other cycle I've lived through or studied, this one had a super bubble of excesses that were generated in advance of the Great Recession occurring. And in actual fact, that's what precipitated the Great Recession, in my view. So 5 to 7 years worth of excess. Nobody had ever seen anything like that before, not even in the Roaring '20s. So when that kind of thing happens, it doesn't really matter how much stimulus you throw at a marketplace, you are going to be down for a long time. And so we said right off the bat, look, this is going to be a long and drawn out event, not because it was also a financial crisis, but because of the extent of the bubble that preceded it. And so we were waiting and waiting in the post-global financial crisis period, and we figured somewhere around 2015, 2016, the economy would be ready to get back on its feet again. And it started to do that, but we ran out of patience. Essentially, global populism and acrimony against failed policy in the perception of many that did not actually get us back to a regular growth period of time caused us to lose patience with leadership, and we then became very protectionist. So if you wanted to win an election, you needed to jump into that camp, or at least to fashion your rhetoric around that. So the rise of Trump should not have been any surprise in an environment like that, and the rise of populist leaders around the world. And so here we have a situation where the economy was ready to reboot, but because of all the uncertainty that this bombast injected into things, uncertainty prevented us from actually launching into a true recovery. Now, you need a certain amount of enthusiasm after that many years, because the advent or the boom in information that technology has made available to us has made us rather myopic. And so if we're down for 3, 4, 5 years, our memories get very misty and faded about what the operation of a regular cycle is supposed to be. And so we really did need some kind of a reboot to get us going when 2016 rolled around. And what we got was the opposite. Okay, so enough for the lesson in history. Well, just give me a couple of more minutes for a history lesson, because we need to ask ourselves the question, okay, well, what kind of conditions preceded the onset of COVID? Well, if we had a bubble out there, then COVID would simply have been the needle that came along and burst the bubble. And my express opinion is that that was not the case. How could you argue that the post-global financial crisis period did not have a proper recovery, had insufficient growth, and then somehow dream up that there was a bubble that preceded COVID-19? Some would say that unemployment rates were low enough to justify the existence of a bubble, but we actually saw the opposite right across Western Europe and in the United States, which adds up to roughly 50% of global GDP. We had the presence of an anti-bubble, pent-up demand. And pent-up demand is actually a great reason to believe that the economy still has tremendous growth potential. Some think me a heretic for saying that, and that might be grist enough for a good conversation at the end of this. But I absolutely believe to this day that the rebound from COVID-19 was predetermined by the existence of this pent-up demand. So I had a bunch of slides to sort of corroborate that, but they wouldn't have worked in this format. So that's why I've spent a fair amount of time just describing things, and I hope that's been clear enough, because now we're going to launch into the data itself. What is it telling us? Well, first point I'd like to make here is that all of the data has been supplanted by one brand new series that did not exist in January of this year, but it has become the preeminent leading indicator of economic activity. And that is, ta-da, the COVID data itself. Now, a modern marvel is that you can have the onset of a pandemic that is so serious that technology enables the creation of real-time data. And Johns Hopkins University was the first to latch on to this, and we now have a 20-minute cadence of refresh on global incidences of infection, death, and recovery. This has become the preeminent leading indicator, bar none. There is nothing else that is like it. Why is that? Well, when infection cases rise, we generally see economic shutdown, either full, as we saw in March, or partial, as we're seeing now, with second wave infections setting in. If we see a flattening or a reduction, that's where the closures end and the economy in turn picks up. So we are looking very fastidiously at this data on a country by country basis because, of course, EDC does business in up to 200 different countries a year on behalf of Canadian exporters. And my group is responsible for doing the risk analysis surrounding that. So we have a compendium of countries and we do 7 ratings per country. We make that available to the general public free of charge on our website with an interactive tool that goes into all of that. And in order to keep up on that, of course, now we have to pay very careful attention to how this data is doing on a country by country basis. So this is number one. And for all businesses and strategies and investment strategies as well, this has, for the moment, become the preeminent indicator. But what are some of the other indicators actually telling us? What is going on? Where are we at in the continuum? Well, we've actually lived through the plunge in activity to see a new day. And we're on that happier part of the continuum where we are rebounding. But the great question is, well, what kind of rebound is this going to be? Well, here's where the letters of the alphabet have become very handy because we economists and others are characterizing the potential for rebound by letters of the alphabet. What do we mean by that? Well, the most desired is a V. You plunge down and you rebound very instantly. You dust yourself off and move on with your life. That would be everybody's most desired outcome. But is it actually happening? Well, you have variations on this theme. You have the U-shaped forecast. You go down for a while and you stay there. You stay in the chasm and then automatic mechanisms bring you back. And so there are some that have been in that particular field, fewer now, because of what has happened more recently. There is the dreaded L-shaped forecast, and that was mostly, our experience in the post-global financial crisis period. You go down and you never actually really come back up appreciably for a long, long time. And that was about a 10-year stretch of next to nothing that we were seeing, in my view. There's also the W. You go down, you come back up, maybe fully or partially, but you have to go back down again because you get nasty second wave infections that take output back down again until you can get on your feet. And that is most concerning, maybe not as concerning as an L-shaped forecast, but confidence becomes a problem if the economy goes through too many wiggles. You just get jaded, you lose money on the way up because you think that it's the real thing, and you get reversion of growth and, of course, incur additional losses when you're betting on a recovery. So where are we actually then? Those are the options. What is actually going on at the moment? Well, my next chart is one of my favorites because I've picked on retail sales here. And I'm talking here about Canada, the United States, and the Euro area. What's marvelous about this chart, folks, is that we have 2 months down and 2 months up, and all 3 of these zones have gotten back to pre-COVID levels of activity. So the 100 really is 100% of pre-COVID activity. I'm stretching this back to November of 19 just to give us a bit of relief, but this is a V if there ever was one. Now, why is it important to look at retail sales? Well, the consumer in any economy is about 60% of activity. And that's the case for Canada. So it is the bulk of what it is that we do. And if the consumers are feeling like this, well, we have great reason to be happy. some might say, well, should we be as happy as all that? I mean, there's been a ton of stimulus dropped into each of these markets. Is it stimulus that's just artificially creating this rebound here? Well, I would agree with you and feel that way if there wasn't evidence to strongly refute that. First of all, I have argued strenuously that there was pent-up demand ahead of time that suggested that when we were ready to come back, there was lots of economic oomph to do that for us, whether or not we had stimulus. But there are two other sources of pent-up demand that have actually increased over this period of time. Number one, during this V, lots of us have still had our jobs. I'm very happy that, I'm still drawing a paycheck right now. Some haven't, and I feel terribly for the millions of people around the world that have been displaced at this point in time. And that's why we're actually trying to get back to the other side of the chasm. But for those who have the privilege of still drawing a paycheck over this period of time, there's been far less to spend on. So what we've observed inside of central bank data is that right around the world, bank balances have been ballooning, actually to the point where the net increase in these balances is rivaling accumulated lifetime savings. Well, that's a mountain of cash that's piling up inside of the system. And it's also corroborated by our national accounts data, which here in Canada have shown that our national savings rate has gone up from an average of about 3.5% to 28%. Well, there are billions of dollars that are hidden inside of that jump in the savings rate that are fuel for a rebound when we're ready to spend all of that. So when stimulus peters out of the system, we are going to have a lot of reserve cash in addition to all those that are getting their jobs back, spending into the system. Now you might say, well, a lot of people lost their jobs, so won't that offset the people that actually have jobs and can pour money into the economy? Well, good point. But the thing is that we're also seeing that stimulus checks aren't being fully spent. People that are grabbing a check over this period of time want to spend as little of that as they possibly can because they don't know when they're going to get their jobs back. It's very uncertain for them. So there's even saving that's happening out of that. So the pre-existing pent-up demand, the pent-up demand from those that are drawing a paycheck, and the pent-up demand from those who are saving part of their stimulus checks is all, evidence to me that all is not lost when stimulus comes out of the system. There's a lot of automaticness to the economy that will see us through the other side. Well, is it just the consumer? Are there other parts of the economy that are rebounding as well? Well, this slide talks about the export side of things, and there's a V-shaped recovery in place here as well. It's a bit slower, but I'm very happy to say that Canada is ahead of both the United States and Western Europe per up-to-date numbers at the moment. We are back to about 94% of our pre-COVID levels of activity in terms of our trade. And I think that against the prognostications of some that said, well, look, if anything is going to kick international trade in the teeth in a big way, it's the protectionism and the fear factor that rises out of COVID-19. And that just hasn't happened. So we see a tremendous rebound, at least on the merchandise side of things. Goods trade is back, or is getting back very quickly. By the way, the Euro area was ahead of Canada. We only have June numbers. And what we're seeing in terms of statistics coming out of Germany, a very big European trader, is that has continued through July as well. So on the export front, all three making their way back to the 100% mark, and doing so at a rate of speed that many did not expect was possible. So is everybody doing the same in here? Do we see a situation where this is indeed everybody's experience? Well, the next chart says an emphatic no, because this is a good side of international trade. The service side of international trade, which has a very heavy tourism element, both business and personal tourism, is for at least up until this point, an L-shaped recovery. It's not doing well at all. And so we are watching this very carefully. It's not a surprise that this is the case, but it is a concern that there are significant elements of the economy that are not coming back. Now, if we actually flip back to goods, and these are Canadian numbers that I'm showing here, you can see that even inside of goods, okay, so the gray dashed line there is the same one that I showed you together with Europe and the United States. That's the one that's 94% back. That's not the right way to say it, actually. It's back to 94% of pre-COVID activities, so an overall 6% decline, as opposed to a 33% decline when we were in the crevice there. You can see that industry by industry, there is a wide variety of experience. So the blue line on the top there is the food sector, and it has been doing tremendously. We all thought if we're going to run out of food, we're going to stock up and so forth. And so we did that. This was an industry that actually outperformed during the COVID period of time, and it stayed up at those levels. So we saw that domestically, but it was also the case for trade in food. And of course, EDC keeps our eyes on trade. That's where we're best. And it's a place where, of course, the economy has been most vulnerable. So kudos to the food sector. Crude metals and minerals has also managed to stay up there, and also building supplies. We've all gotten busy renovating our homes, putting a deck on the back, doing other things, and forest products have done tremendously well inside of this. So those are all above the line industries. What about the other side of things? Well, if you look at the aerospace sector, sort of a brownish line there, they've gone down and they haven't come up. And that's very connected to our reticence to travel at this point in time. Well, that's a highly capital intensive industry, and they're under deep duress. And of course, they're a big part of EDC's book. So we're very, very close to these numbers and quite concerned about how this industry globally is going to do as we come through. Energy is also an industry that's been highly compromised. They've done worse in percentage terms than the aerospace industry. There has been some comeback, but this is one that is going to be down for quite some time. And of course, with the carbon footprint of this industry, there are some that actually want to keep it down there. NGOs are rallying and trying to make that the case. Well, that has serious implications, particularly for Western Canada, but also for Toronto, which is the financial center for the energy industry. And so we'll see how that one plays out. That's an industry that we don't expect is going to be coming back anytime soon. Well, what about a very key one for the Ontario economy, autos and parts? And you can see that the very bottom line there, autos actually was the worst affected industry, but it's also the most improved. And so it's gone from being the worst performer to being second best on this chart. They're back to 112% of pre-COVID levels of activity. The point behind this chart, folks, is that, one size does not fit all for this recovery here. You have ones that are very much outperforming. You have others that are deep down in the basement, and the rare one that has fallen into the basement and come out very, very quickly. And so it's very important strategically to understand that the outcomes are splayed here. And whether you're managing a portfolio of investments or a book of loan business, or whether you're actually trying to strategize what businesses you're going to do business with, this is highly instructive here. One cannot take their eyes off of this as a phenomenon. It's highly concerning as well for the economy. Inside of different industries, you have winners and losers as well, because those who have tended to digitize more quickly are actually on the upside. The ones inside of their industry that are doing more poorly are the ones that really have not adopted and embraced technology and done things like what we're doing today by wire. And so key insights come out of what seem to be otherwise bland data points. If we look at the entire economy, this chart here is intended to display just how different things are on an industry by industry basis. So this may be too small to see on your screen. I will definitely make this deck available through Catherine, and we can distribute it to anybody who wants it. But what is this actually saying? Well, these horizontal lines here, the left-hand side indicates the degree to which, in percent of pre-COVID output levels, industries have declined. So the big red down on the bottom there is the auto sector, which declined to 9% of pre-COVID levels of activity, an absolute catastrophe for the industry. But then swing over to the right-hand side of those horizontal bars, and that's the degree to which industries have come back. So there's a lot of information packed into this chart, but it gives a one-stop visual on how things are doing. So right at the top of the list, retail was hard hit, but it has zoomed back to more than 100% of activity. The second industry there is the finance and insurance industry. It was barely touched, it hardly moved, and it's now back to over 100%. You can see there are 6 industries up there that I've colored green because they are hugging close to 100% of activity. Way down on the bottom there, you see, okay, I think something happened here. Somebody tried to call me, so I will reshare my screen. Apologies for that. Way down on the bottom, you will see 2 industries that are there, and they are very related to tourism. So sorry, it's hard to read there, but we've got accommodation and food and arts and entertainment. Of course, that has virtually shut down. You can see high drops in those industries and barely really coming back. We got a few other things down there. Textiles is one of them. The auto sector, obviously, another one that's in there. And so some duress. And then a real mix in between. You got a real wide variety. Hardly any industry having identical experience in this whole continuum. So just another evidence of the extent to which this is a really varied outcome when you cut it down to the industry level. Incidentally, it's also a varied outcome when you look at countries around the world, not an equal experience from the developed to emerging markets. And it all depends on the preconditions of going into the downturn. I can certainly answer questions on various countries if you like, but we've got to get through this material here. How about the go forward then? You know, what does the future look like? Well, a lot of that at this point depends on confidence. I'm not a great believer in confidence. I believe it's more symptomatic of other fundamentals in the economy. Others, you know, just sort of think that it's the be all and end all. I'm really not in that camp. But when you have a confidence jolting event, the like of which we've just, you know, we're in the middle of right now, it's primordial. There really is something quite to be said for the importance, the elevated importance of confidence at this point in time. Well, look at this chart here. These Canadian numbers say that we're really not having a terrible time with it now. We did initially. I mean, these drops are virtually, well, they're not without precedent, but they are highly unusual in the time series. And the speed with which confidence plunged is also highly concerning there. Well, I'm very happy to show you this and see that business confidence is back and consumer confidence is almost all the way back. So these are preconditions to the reemergence of spending, and we're seeing that happen on the consumer side of things. Investment will take a little bit longer to gear in because it typically has a greater lag in the economy than consumer spending. So there's a bit more wait and see on the investment side of things, but the preconditions are definitely there for it. Okay, let's keep moving. Then what is all this doing to financial markets? Well, there's a complication here because the return to work has actually boosted stock markets. And so we see various measures of equities there that are really off the bottom and getting very close back to 100% of pre-COVID levels of activity. This is normally a key leading indicator of economic activity. So we pay very close attention to this, as do others around the world. Most composite leading indicators, country by country, do have broad equity indices in them. And so we pay attention to this, but the complicating factor here is that we've got very low interest rates on bonds, which is switching money from the debt side to the equity side of the marketplace. So there's a bit of artificial inflation in equity markets coming from that. And of course, the reinstitution of quantitative easing in the United States and the continuation of same in Western Europe and the initiation of it in Canada and other parts of the world is, of course, something that puffs up equity markets, in my view, and also distorts commodity prices as well. And so those phenomena are actually leading to what I believe is some artificiality inside of equity markets. And by the way, I was saying that before the turbulence of the last few days. And so You can check me up on that. I'm online opining on that, and that certainly seems to be what's embedded in the corrections or the mini corrections that we're seeing at the moment. We don't expect this situation to change much. Quantitative easing is going to be around for the long haul, or at least until there is some reemergence of inflation inside of the economy. Then central banks will start to tighten up on things. So I don't really expect too much change in this situation. So what is this all doing to commodity prices? Not a whole lot. We're not expecting oil prices, natural gas, or copper to do much. The fact that gold is moving at the moment is not a good thing. Gold is good for inflation, deflation, a financial crisis, a fiscal crisis, pretty much any other kind of crisis out there as well. And, you know, it takes me back to readings that we did at Crescent of Somerset Maugham, you know, talking about, I think it was Elliot Templeton and how he bought gold just prior to the Great Depression and made a killing on it as well. Would that I had paid a little more attention to that just a couple of years ago, but I'm sure we're all licking our wounds on that one. I do believe that gold will be at elevated levels for quite some time. I'm not quite in the David Rosenberg camp thinking that it's going to go to $3,500 an ounce, but I've got enough in my portfolio that if that happens, I'll have a smile on my face. Anyhow, that's how we see things for the time being. On the currency and interest rate front, not much movement in currencies, which is an anomaly. With low commodity prices, typically we would be taking it on the chin on our currency. But the fact is everybody's currencies are under duress at the moment because of anticipated moves by ratings agencies dealing with the amount of sovereign debt accumulation that we are seeing in just about every country around the world. So our currency isn't moving, but it's because everybody's currency is depreciating at the same time. And that's probably an historically unprecedented event as well that I'd love to talk about in Q&A if you so desire. So here you can see our interest rate profile not changing much over the next little while. And here it boils down to our outlook. From a sort of tepid year, not much really to talk about in 2019, a year actually where there was much speculation about whether we were going to fall into recession or not, 2.9% on the bottom line, not much to write home about, and a number here that was unthinkable in January. You would have been certifiably insane in January if you'd said anything like this, how quickly things change. This is shared by developed and emerging markets alike. Major shocks happening in the emerging world here. India had expected to grow by somewhere around 7% and to flip-flop that around to a minus 12% almost in their economy. An absolute sea change in the outlook. Mexico, the same. Brazil struggling as well inside of all of this. And right across the developed world spectrum, a variety of opinions. France perhaps taking it most on the chin there. And then we move into 2021 and we see 6.6%. Are we dreaming in Technicolor? 6.6, folks, is not enough to take us back to pre-COVID levels of activity by the end of the year. So this is hardly a robust rebound that we are seeing here. The shape of the forecast is initially a V, and the V gets a little bit bent as we go further out. And that's because of second wave infections and the ultimate impact of the debt accumulation that we are seeing and the future tax liability that's implied by that and how that competes with the private sector for growth as we go forward. So let's just boil it down to 5 key takeaways. I hope these are going to come up because the reformatting might have messed me up big time. Well, at least point 1 is coming through. Remember, the pandemic is paramount, and that containment is going to be critical to the outlook. So I can say whatever I believe here, I've had to make assumptions about how this particular element is going to go. So how goes containment, goes the economy. Now, if we all happen to get a vaccine that is widely distributable and highly effective, then of course, we will see a more robust rebound than we've factored into our economy right now. This outlook is not contingent on a vaccine being developed, but it is contingent on very strong containment measures being applied around the rest of the world in a way that enables growth. So that's a critical element here, and we all need to keep our eyes on that pandemic data. Second key point, I've made it, I'm just reiterating at this point, but be very, very careful because the the recovery is going to be very uneven. You have to be very selective about industries and very selective about countries that you are dealing with. And of course, the impact is on the individual level as well. So banks will be looking at individual customers with a different eye in the next 6 months or so. Thirdly, I haven't said too much about this right now, but what this is giving rise to is a level of insecurity that is causing firms to reevaluate how they produce. Technology enables far more mechanization than we have employed right now. But if necessity is the mother of invention in normal times, crisis is the mother of transformation. You can see flashpoints of change that happen in the economy that hit us instantly and cause us to redo the model. And I'm hearing more and more Canadian exporting CEOs saying, we've got to do things differently. We had a labor crunch ahead of this. They were already thinking about it. Now is a time where we are seeing tech stocks absolutely going through the roof. Why is this? Because those who have deployed technology up until this point are the ones that are doing best. And there's a great motivation and incentive to catch up right across the industrial spectrum. And perhaps no more inside of those companies that really have an existential threat at the moment. So we see this as being a phenomenon, and there are many, many applications of this observation that could be taken out of this, but that's one that we really would like you to keep in mind. Fourthly here, there's lots of talk about securing the supply chain. So buzzwords are coming back: reshoring, nearshoring, globalization, in a way that transforms trade. Now, lest you think that this is just a consolidation of things inside of one particular zone of the world, beware, because globalization is as true for Asia as it is for Canada. It's as true for Western Europe as well. So if production is going to be concentrated inside of zones where the products have their main market, then we are going to see investment move around the rest of the world. If you're selling in China, you're going to locate more of your production there. If you're selling in North America, it's going to be here, and likewise for Western Europe. So we do expect that there is going to be this grand shift. But fifthly, we do not believe that it's going to be instant. The rapidity of growth at the moment means that investment can't possibly keep up with all of this. We are defaulting to the system that's in place now. So relax for the time being. The current supply chain mechanisms are the ones that are being most fully utilized. But we do believe that there is going to be a trade transformation. And I'm talking with Canadian government officials about how we can leverage this to Canada's benefit. If this really is going to be happening, and if mechanization is going to be happening, well, there are some key stories that Canada could be a great beneficiary of. Well, this slide here talks a little bit about some of the free stuff that we make available to you. So our country risk quarterly, I've already mentioned, over 200 countries covered in there, 7 ratings per country, and we have tear sheets country by country, very easy to use. This is our global export forecast. I write a weekly blog called The Weekly Commentary. It comes out every Thursday morning. You can get yourself on that list. It'll automatically be delivered into your email. We also do a video version of that, so you can see me every week if you really want to. And we have a few other things as well that might be useful to you. Visit us at edc.ca.